give you the first profile page. Tell me if you can see this, okay?
Looks good. Looks good.
Okay. So in terms of ideas, right? Obviously, as you said, I'll come into the Wyckoff and that in a second. But part of what interests me, I guess, kind of overall, is the growth in technology. And I know one of the posts that I published recently on TradingView was about the Chat GPT and using that to create the PineScript code. Now, the reason for me, and the reason I wanted to touch on this before going into Wyckoff and Elliot, is that I kind of see the markets evolving. And I think the fact that there's tools and AI tools like this, I think it's a great time in the markets to use this. But I also then get curious as to what information this is sharing that almost drives you back into Wyckoff and Elliot, right? So what I mean by this is if you look at, bot trading, algo trading, all of this, a lot of people, again, they kind of come to me saying, oh, what do you think of this algo? What do you think of this indicator? What do you think of this bot? The reality is, if bots are that kind of up to speed right now, we wouldn't have doctors, nurses, accountants, lawyers, policemen, because they would all be professional bot traders, using indicators to trade. So this is where I think the market, although some of these ideas are, 100 plus years old, we can cover what the sentiment, right? So I'm going to find this particular one I've pinned out, right? This one here. So I posted this a while back. And what I like with this kind of concept is it leads into the Wyckoff and the Elliot kind of methodologies, but in almost a simplified version. Because when you read from kind of left to right, you get this, hope and disbelief in the market. You get this optimism kind of rally up and run up. Then it's obviously this almost false belief because you're getting excited. And this is the kind of time you start to hear, your friends, your family, people who are not investors talking about this type of investment. And what I like about this, right? So from where you can see how the market cycle works, it kind of leads into what you then have from how Elliot and how Wyckoff and how things like Dow theory comes to be, okay? So the reason that I say this is if you look at how a cycle works from an accumulation phase on the, on a way up, you have almost then a reaccumulation followed by a distribution, a redistribution, and kind of back to the accumulation phase at the bottom. These things can easily be identified using Elliott wave as a theory. But within those Elliott waves, so if you look down onto the left-hand side where I've got the Elliott wave box, you've got the 1, the 2, the 3, the 4, the 5. When you hit the 1, you're looking for the distribution. When you hit the 2, you're looking for an accumulation. When you hit the 3, you're looking for another distribution. And therefore, these things can move on and on and on in the cycles. But I think overall, you've got to remember these markets are also fractal, which means this happens on a smaller and a larger time frame than probably most retail traders are willing to look at. So for me, when I look at all of this combined, I'm looking at techniques that are 100 plus years old, not from a technical analysis perspective, but from the sentiment analysis. And I believe that these guys understood retail sentiment, 100 plus years ago. So
I want to say on the sentiment aspect, there's actually a Warren Buffett quote I love, but it might, and I might not say it correctly, and he might have taken it from someone else, but it's something along the lines of about envy in markets. And it's, it's about how real envy in markets begins when you hear your neighbor is getting rich.
Yes.
And that to me is sort of the timeless cycle of markets. And you kind of were commenting on that at the start of this, which is, when you hear that your neighbor's making in money in markets, and there's sort of that proverbial story of like, maybe your wife hears that your friend's husband made a lot of money in markets, and then she comes back and says, hey, Jim made so much money in markets. And then now I have to get into markets. If Jim did it, I can do it. And then it starts to ripple throughout all of society, really. And the 100-year-old techniques of some of these trading styles is fascinating in that regard. You're spot on. They might have been talking about this for 100+ years, and that's sort of what Wyckoff was doing. Is that right? What Wyckoff method is? He developed
Yeah.
that in the
So
1900s.
yeah, so in essence, the way that I see this and the way I believe this to be is, although it's a technical analysis kind of tool that I guess most people would view this as, I feel that the markets have changed and evolved, and this is why I touched on the chat GPT, at the start of talking about this, is that you've got things like on-chain analysis, you've got data that, wasn't available 100 years ago in markets that wasn't available 100 years ago. So I think for me, what I see that hasn't changed, right, is that when you look at something like Wyckoff or Elliot, they are actually assessing the retail sentiment, and human emotions haven't changed all that much in 100 years. We're still driven by fear. We're still driven by greed. And it's these two components that ultimately give us, the sentiment. And I think, when I talk about this, people say to me, oh, Wyckoff's no good. It's 100 years old. And all I got to do is come back and show them this, right? And, you know yourself, what you have in TradingView, it's an immutable ledger. The fact that I can call these calls, long at the bottom in 2020, the reaccumulation, this isn't guesswork. This is the fact that humans have already forecasted where they want to see this. And I feel the market is almost an algorithm seeking liquidity, but the liquidity is often the retail players. That's now easier than ever from a professional standpoint to trade against. Because when people say to me, oh, you're wrong, Bitcoin's going to, 135K next month, it's so easy to see why it's not. And this is a massive advantage when you understand what to look for.
And what in terms of the sentiment aspect, and well, we'll talk about Elliot Wave in a second, but I want to stick to Wyckoff. Richard Wyckoff, is that right? He was the founder of it.
Richard Wyckoff, yep.
Is the whole idea that you're charting waves of sentiment? Oh no, I guess he's not. Is that kind of the way to approach it? Like the market, nothing goes straight up, nothing goes straight down. There's always sort of retraces. Is that the underlying concept? Like there's sort of a wave function to the market.
So not quite. So what I'll do is, if I explain this a bit more, right? I'm going to put the Elliott wave on the chart to start with, right? You've got got a sequence like this, right? What you have is at the 1, the 3, and the 5, you would anticipate a distribution. At the 0, the 2, and the 4, you'd anticipate an accumulation, right? So what tends to happen from a Wyckoff perspective, as the price comes down from wherever it's been before, you see, first of all, what they would class as a seller's climax, right? Now, I know there's another move in this right over here, but in essence, what you're looking for is a reaction to a price, right? So it's almost like saying, I've sold enough, I'm now ready to start buying. But if I buy too much too soon, everybody's going to jump on the same bandwagon. So what the Wyckoff methodology kind of shows and what it kind of represents is the sentiment of the retail and the masses inside a range, which is why it's called a schematic. And therefore, from a seller's climax, you would expect then what they regard as an AR. And an AR is basically an automatic reaction to that price stopping at a level that maybe a fib level might have forecasted this, from a long time ago. So what you start to see is the range bound movement, sideways movement. If you look at this from a much bigger time frame, so a monthly or a weekly time frame, a lot of new retail traders look, almost too close. It's like they can't see the wood through the trees, and I think the trouble then is when you understand what the market is trying to tell you, it becomes pretty obvious when you see these kind of sideways actions and range movements, because from the seller's climax all the way through to an AR, you then start to see other moves that basically do this in the side. And all you're seeing is either, higher highs and higher lows, or lower lows and lower highs if it's in the inverse. But it's actually telling you a story. And the story in there is allowing you then to understand what the sentiment is. So without turning on Twitter or, Twitch or TikTok, you can actually get a feeling for what the market is looking at right now and what the market is telling you right now, especially from a retail perspective.
You know,
So
I must say, before we go on to this next idea that you just pulled up on the screen, which I think is, something people should read. And by the way, I actually forgot to mention this in your introduction. Mayfair Ventures has over 12,000 followers on TradingView and has published 372 ideas and has been on the platform for 8 years. So I must always say 8 years of publishing is pretty dang impressive because of the consistency that takes to write that much and to be active. So, I tip my hat to that. And now going back to something you said, which was the market is an algorithm for liquidity. I think that's kind of what you said. I think that's so cool. I've never heard that before, but when I hear it, it makes sense of the aspect of, well, that's right. Like the market can't exist without trading volume. That's how all the brokers and middlemen are really making money. So of course, liquidity is sort of the natural zone that would attract price. So I'm so curious to hear more on that. And is that something you've learned over time? Is that sort of your phrase for the market?
yeah, I think, for me, as I said, because I started in stocks, not really understanding, what drove the market. It was almost like, something happened. There was some kind of, big event or something you'd read in the newspaper, and you could buy based on that. As you said, earlier, about when your friends or your family buy in or have told you that they buy in, that's often the time to start running. And I think for me, when you start looking at the Forex charts and you start seeing what happens, COVID, was announced and the lockdowns kind of happened. Oil went negative for the first time. All of these kind of factors, you start to question the why, rather than the what. And I think for me, when I look at the Wyckoff schematics and obviously understanding that this is sentiment rather than technical, is that you've got to put yourself in a retail position on a smaller time frame. So the reason I pulled this chart up is this is kind of the inverse, right? So back in March, in 2021, when everybody was off, Bitcoin's going to the moon, there was an obvious sign on the 18th of March as to why it wasn't. And this is actually where we were at this kind of time, right? So understanding that retail sentiment was let's go long, what's the obvious thing we're likely to do? It's the opposite, because 90% of retail are losing money. So when you start to see, hey, we've dropped down for an AR, retail's reaction at this point in time is let's buy the dip. And at this point, they kind of feel that they're right because it's working for them. It's set and forget. I'll come back next month and I'm going to be rich. And the reality is we then create this kind of sign of weakness, the SOW, which is like, oh shit, I've just made this. Now I've lost all of this. I'm now in a position of uncertainty. And it's that uncertainty, which is why the markets then carry on sideways rather than kind of any form of direction, that keeps retail guessing, whilst what we regard as composite man, and another Wyckoff term, composite man is basically a kind of collective of kind of operators and the big players in the market. So what people would regard as kind of smart money, or some people will refer to it as, institutional money. Some people will say they're market makers. I think for me, it's all of it. So it's kind of, composite man being, multiple entities kind of almost treating the markets as a bigger player against us smaller players, if you will. So I think when markets start to kind of paint the story, and I think, this is why I'm going to stay on to this one, right? But I'm going to go into the level, I guess, in terms of why and what this was on this one here.
Can I,
right?
load that up? Can I quickly though make sure I understand that it's called composite man?
Composite man, yes.
Okay, so that I've not heard that before, and that's so cool. One phrase that I really like, and I think a lot of fundamental investors will relate to it, is the term Mr. Market, where the Mr. Market is sort of this, this mysterious being that is just, it's the market all moving at once, and there's not really much you can do about Mr. Market. You just kind of have to listen and respect Mr. Market because it's sort of impossible to predict. There's so many traders and investors out there. And I think it's actually, once again, Warren Buffett who often refers to Mr. Market as this sort of like friendly being who has manic episodes of euphoria and panic. But
Yeah.
composite man is I have never heard that before, and I love hearing these names for, this sort of this system that it's just so hard to describe to people. So, tell us a little bit more about composite man, and is that something you refer to a lot?
Yeah, it is, and I think the thing is, it's it's almost the unknown in the market because there's a couple of different factors that come into play, right? So I'll come back to this chart because this is relevant to the composite man and the composite operator. So in essence, one of the things that I use a lot of is what they call COT data, right? And COT data comes in a couple of different forms, but in essence, what you're actually seeing in this here is the way that the big boys are actually trading the market right now, right? So this is lagging in terms of the data. This is kind of a week old. Now, obviously, you guys in terms of trading, where you guys got an indicator for this, which is brilliant, and I think ultimately all I look when I look at this market is what's happening in the shorts, and I see this as relatively sideways. I could draw two horizontal lines there and basically put the shorts into a band, but I can actually see a slight uptrend on the move from the longs. So painting kind of the summary would suggest that, for me, Bitcoin is in some kind of an accumulation phase right now. Now, the reason that I bring that up and the reason I say that that's kind of where I would start for this for composite man is now I want to drill down to, if I assume that we're in an accumulation phase, what am I looking for within the Wyckoff schematic that kind of adds and reinforces my belief that I'm in that accumulation phase? So go back obviously to the first, real all-time high, the kind of 64K Bitcoin, 2 years back. And this for me was seeing the extension from an Elliott Wave, which is why I have the number 3. I was seeing a 3 extension. I was seeing the reason for distribution because we had what I would regard as an AR down here. And then from there, I was anticipating the move back up and back down to the next level of liquidity around the 28K mark. Now, bear in mind, this was all forecasted in March for a drop that we saw in June, July. So the fact that the algorithm is kind of working gives me more confidence and belief in the Wyckoff and the Elliott kind of combo, that humans are still trading with sentiment based on beliefs, influences, and obviously the social media aspect that they've been kind of brought up into.
And so if I understand Composite Man 2 correctly in this regard, he's actually taking the other side of retail traders. Is that right?
Exactly.
So on that note, I have never heard this before, so I pulled up a quote about Composite Man from Wyckoff. I just want to read it. He says, all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operation. Let us call him the composite man, who, in theory, sits behind the scenes and manipulates the stocks to your disadvantage. If you do not understand the game as he plays it, and to your great profit, you do not understand it. That's incredible. So anyone listening, yep. I hope that this is super enlightening. I just learned something new. I've been in markets for 10 plus years. I've never taken the time to actually read into Wyckoff or Composite Man, and this is just great to hear. And going back to the sentiment aspect too. I just want to tell you a quick story about last year, because you had mentioned last year's Bitcoin top and how you're reading the sentiment. Well, actually, before I tell you this story, so to you, retail, if you're a Wyckoff trader, retail sentiment is contrarian. Is that correct? Like, yeah. you always want to be on the other side of retail. Is that, if you're a true Wyckoff trader, is that right? You want to be on the other side. Yeah. Got it. So on that note, I have a quick story, which is, I had a friend who had only been trading for about a year, about, let's say 16 months ago, near the exact top that you were talking about in Bitcoin. and I heard him over talking when we were just at a small dinner, and he was saying, crypto trading is so easy. All you have to do is just keep buying Bitcoin. It's like free money. And I remember hearing that and saying to myself, this is like what they write books about and stories about. When you hear someone talking like that, get out. And
Yeah.
I did not listen to my own advice. I'm somewhat of a long term investor, so I've been holding through some of the difficult drawdowns. But when I heard you mention the Bitcoin top, I thought about that story. And I don't know if you ever have experiences like that, but if you are trading the opposite side of retail sentiment, if you hear your friends or family talking like that, or colleagues, do you immediately say to yourself, that's a red flag, or are you only following the chart?
Yeah, I mean, I think it's kind of two things, right? You got I suppose people that and you'll kind of get a feel for their lack of experience in the market, and I think when they start talking about technology or stocks, yes, your ears kind of prick up in the sense of it's ready for getting rid of. But I think, like I said, going back to what I said earlier about being kind of in the VC and the trading kind of, both camps, is that you've already kind of preempted this move. And I think this is what I'm showing on the chart here, is that before people started calling for 100K Bitcoin back in 2021, there was so many signs highlighted. And when I've drawn the 3 and the 4 there, these are not lucky guesses. These are not, hey, I think it's going to do this for this reason. It was the market telling me that this was going to do this for this reason. And the liquidity, the algorithm was already pre-programmed. So I think the fact that new traders were coming in buying 62, 63, 64K was the liquidity required for the drop. And therefore, you kind of, friends don't want to believe you until they tell you, why didn't you tell me earlier? And I think this is kind of the problem, with people wanting to come in and get rich quick. Mark Cuban says, something along the lines of, everybody's a genius in the bull market.
That is one of the classic lines. Exactly. Everybody is a genius in a bull market. And that's actually really how I can always tell when a trader is the real deal, is if they can trade bull markets and bear markets equally well. And
Yeah.
that's often where, I've just over time, that's how I found, wow, this person's like a really good trader. They can trade the fun times, the euphoric times, the easy money, just as well as the difficult times when everyone's having a tough time, or they're leaving for good, or they never want to go near markets again because of a bad experience. Yeah. For yourself, using Wyckoff, and we haven't even talked about Elliot Wave yet, do you find that it still works really well in bear markets as well? It's sort of market agnostic, or do you have to change up your approach?
It's kind of a difficult one to kind of pinpoint, because although they work, it depends on the instrument. So a lot of people come to me with what do you think of this altcoin, or what do you think of this new stock? It only works because of the market cap. So it comes back down to the same questions we started this discussion with. If you've got a large market cap, you've got the I suppose the institutionalized instrument as a whole, you've got the big players able to buy and sell the market, it works better for that kind of market. Now, coming on to Elliott Wave, the major issue that I have with Elliott Wave is that it's great when it works, but I think if you were a true Elliottian and you go kind of chasing every swing, you can end up kind of confusing yourself. And I think this is, again, part of what we said just before the call went live, is that, having too much data sometimes is actually worse. Less is often more. And I think that's one thing I see a lot of, in new traders. They come with, 15 indicators, 20 screens, 48 pairs that they're assessing. And I often say to people with instruments and pairs, it's like learning a language. If you're going to go out and learn, Russian and Chinese and Japanese and French at the same week, you're going to struggle.
On the screens aspect, that is a sort of like we kind of have entered a new era. I think because of especially now that you can trade and watch markets from your mobile phone too. And I think you had mentioned to me that you early on in your career used to have multiple screens. Well, it made sense. You couldn't really work remotely. Everyone had to go to an office. You had the big desk, your monitors. You're in a trading room with others, or it's a trading floor. Whereas now, I think if you said correctly, you just use one monitor, right? You've really simplified.
Yeah, and I think less is more, and I don't want to kind of be there kind of plugging what I've done with the book, but I've called the book Master the Art of Trading, and I really believe it's an art form. I think in the grand scheme of things, what I feel about it, and the reason that I feel that it's an art, is that when you try to add kind of science to it, you're adding indicators, you're adding, like you said, more pairs, you're adding more screens, your brain is kind of fried. Your brain is looking for almost a way out. You start kind of second guessing yourself. You start thinking of, what's another influencer saying? And all of these points are really important. So I think when you start to take a bird's eye view and you say, okay, why is the market aiming to do X? Let's look at a bias. Let's look at kind of stepping back and taking a 30,000 feet view of the market. And that then also rolls on to, do away with, your Bloomberg streaming in the background, do away with 15 screens, do away with 15 indicators, trade that chart naked, look at what you're looking at and really spend the time to learn the language. I think that's really, really important. And I think that's part of, anything, you don't see an artist that goes into, 15 different styles. An artist comes in and says, this is my style, this is my technique, and kind of masters that craft.
The aspect of learning the language of the markets, and maybe tuning out some of the noise, I find is sort of a timeless reminder to a lot of people. It really resonates, and I think because there are so many notifications and there are so many news sources now for markets that it's really easy to get overwhelmed by it. And I can actually say when I was watching, early on, I would watch some CNBC to see what was going on in markets. And I found that because they would get so excited about these like big crashes or these big rises post earnings or before earnings, or maybe news drops middle of the day, it would sometimes sway me to take almost like a news based trade, which I don't think I ever had a good experience doing. And I finally did turn off CNBC. I'm not knocking CNBC, but let's just say any market news for good. And it helped me a lot because it brought me back to the language of markets. I would just spend more time looking over charts, for example, or maybe blogging about what I'm seeing or writing an idea rather than following the emotions that might happen on some of these channels. So that I will say what you said there resonates with me. Do you watch any market news?
It kind of comes back full circle, right? So what we've talked about so far in terms of Wyckoff and what I touched on with Elliot and the kind of sentiment analysis rather than kind of technical analysis, we've taken fundamental off the table by not listening to the news. We've taken influences out of the equation. We've now got the fact that, I want to learn about the instrument that I'm assessing, and I can spend all my focus on one screen, to do that. And I think this is kind of the point. So when you come back to what you've just said, the sentiment analysis on Wyckoff or Elliot, it kind of comes back to being more true and probably truer than ever, because you were seeing social media kind of show its hand. It's almost like playing poker, and somebody's actually lifting the cards up and showing them to you. And I think this is the main point. When you take that step back, you could almost see the market from a third person view rather than from, you can't see your hand in front of your face because you're too blind looking at too many things, and too often, over trading, over complicating it, too many indicators, too many screens, too many pairs.
So on that note, I think we have to talk a little bit now about Elliot Wave.
Yeah.
And I think what's fascinating about Elliot Wave and Wyckoff, as now mentioned a few times, is these are approaches that are now over 100 years old. And I do think when something's lasted the test, it's lasted over the period of time like that, it does say something. There is something that's hard to ignore about anything that lasts over 100 years. And I'm curious, though, I've always found it difficult to see how the two approaches are different. They seem very similar to me.
Okay, so what you have, right, is going back to what I was showing on, which was this one here, is that if you can combine the Elliott wave cycles, and you can look at which schematic you're looking for. So I'm looking for a distribution, or an accumulation. What I can do is kind of come back to the assessment to say, okay, what am I looking for at the time that I'm looking for, right? So for example, this is where the two combine, right? I posted this in August, the 24th of August, 2022, I believe, right? And this particular post was using, as you can see, the Elliott Wave count. So from the bottom, 1, 2, 3, right? And the idea was that I was now looking for the distribution. So as you can see, I'm expecting the price to come down. This is where the post was posted. We come down. And then what I went into was the detail as to why we would only go up. And if you look at this, the date is on the top left, 24th of August, 2021. And ultimately, what I'd said in this, if you can zoom right in, is that the monthly 3, so an Elliott monthly 3, is not quite in. We're going to anticipate buyers at 65,000, which was the previous all-time high. And therefore, we're very likely to see 40K again very quickly. And the reason that I could see that, from August through to when the drop actually happened in November, was this was already pre-programmed in that same algorithm based on the fact that we had to come down, we had to go up, and we had to come back down. And if you look at that chart, based on what it did back then, I'll put this on a bigger time frame. If you look at what that chart did back at that particular point, we actually went, wrong button, we actually went from that top there down. This was obviously there, look, 23rd of August. We went down, we went up. I said 65K being the kind of key level. We'd go into the liquidity zone and we dropped to 40K again very quick. 40K is there. There's the quick move before we went sideways for a redistribution. So for me, using Elliott and Wyckoff was, Elliott give me the forecasted levels, Wyckoff give me the insight for the distribution followed by the reaccumulation, followed by the distribution into the redistribution, back into the now current accumulation. So that's how I combine them.
So Wyckoff is really used for almost trying to figure out where the big money is going. Is that right? And Elliott Wave is more for the sort of the actual, velocity of price action.
Yeah. So I use it as kind of bias in the directional bias for Elliott, and then I use the Wyckoff for kind of, I suppose, the entry point, the trigger point, the kind of the rationale behind, are we doing what we should be doing at this kind of level that Elliott has already pointed out to me? So I think if you're a Wyckoff trader, you probably will ignore a lot of Elliott techniques because it's, oh, that doesn't work. If you're an Elliott trader, I don't really want to get into Wyckoff, I trade Elliott waves. And I think sometimes this is, as we said earlier with the car analogy, there's an element of you need to understand what's under the hood, as well as, do you like the look of that car? And therefore you're not going to go and buy, a new Ferrari or Lamborghini if it's got a pig ugly engine, but it looks nice on the outside. What you're looking for is the best of the best. You're looking for techniques, in this case, that will give you the best of the engine and the best of the look and the feel.
I have to ask too, because on the charts that we've been going through, Bitcoin is sort of the one symbol that has remained constant on all the charts we've gone through. And it's I noticed you publish a lot of chart analysis on Bitcoin as well. What's your thinking on Bitcoin? I think if I recall, you've been following Bitcoin for quite some time. Is that right? Would you consider yourself sort of like a Bitcoin original, going back maybe more than 10 years potentially, following and trading Bitcoin?
Yeah, so I got into Bitcoin in 2011, which was obviously a long time back now, and kind of fell into it, I think, because of the technology investments and the stuff that I was doing then. The technology kind of excited me, and it was the interest in the tech rather than a kind of tradable asset. So I ended up buying some Bitcoin, and then kind of switching to put my trader's hat on was, you 10x it, you 100x it, and you kind of think, okay, I'm out. I want the next kind of opportunity. So I kind of got in and out rather than, I've kind of bought it to hold it. And then the idea then was obviously back to, this one here, look, as you can see, all of these are clickable. This was May 2020 saying, look, this is the rationale for, why I'm long Bitcoin. If you click into this, the price then was, $8,900, so I've been very lucky, in terms of what it is. And I guess being in the right space in terms of investing, having enough understanding from a trader's perspective has given me the best of both worlds to say, look, I really appreciate what, and I think maybe the one thing that I've said, especially the people who follow me and they follow my streams, I've kind of highlighted for me that this has been institutionalized kind of in front of my eyes. This is the first time I've witnessed kind of big players coming into the market and kind of changing the algorithm, changing the kind of the mood music, if you will. I think a lot of retail traders assume that, big money comes in, prices only up. I think what they tend to forget, or maybe want to forget, is that these guys want a deal, and therefore these guys will be driving the price to accumulate better prices when they enter the market. So for me, bigger players is not always a good sign in the early stages.
So interesting. You saw Bitcoin back when it truly was, and this is from the trading aspect, just like peer-to-peer trading. It was only people trading with each other, and there wasn't that much volume, to now becoming a global asset where probably some of the largest money managers on the planet are interested in, allocating some money to, diversifying toward. So do you prefer markets in that respect, or did you miss do you actually think it was, I mean, first of all, it's pretty cool to be that early to an asset, but do you miss those old days, or are you happy to see it be institutionalized because now you can see the technology sort of progress?
Yeah, I think it's a double-edged sword. I mean, it's a really hard one to answer because, being lucky was obviously kind of the way I saw Bitcoin to start. I got in at the right time, it kind of rallied, and I thought, I'll look a bit deeper. I think putting my trader's hat on, I'm almost glad that it's becoming institutionalized. I think if you look at what I've got on the chart here, all of these posts, what I keep saying to the people that follow me, what I've said in my stream time and time again, is that, these calls, these moves, why I was kind of long, why I was reaccumulating, why I was short, why long at the bottom, why the reaccumulation here, is the fact that I see it as now being institutionalized. And when you use these techniques and, you've mastered these techniques, I guess it's pretty obvious the more institutionalized it becomes, the easier it is to trade. So while you're not going to get the same, 100x or 1000x returns that most influencers will throw around, the reality is you can kind of make steady, nice returns with a lot more confidence when these markets are institutionalized. So, it comes down to kind of get rich quick compared to make decent money on a regular, consistent basis.
And how about for just, and this is now, I'm just generally curious because you've seen Bitcoin go from this like young asset with not, not just regular people trading it or following it or talking about it, to now it being institutionalized, which I think is a cool journey. You watched it happen in real time. How about longer term, wearing your VC hat now or your tech hat? Do you think Bitcoin really has a place longer term, or have you removed yourself and said, I just trade this and, I've watched it long enough? And tell me about what your thinking is for the future of something like Bitcoin.
So there's two schools of thought, and I think there are also two camps in kind of the world of Bitcoin, right? So a lot of people will say, oh, I can replace the dollar. Other people will say things like, oh, I can replace gold. I think for me, it kind of can't do both. And not so much that it can't, I don't think it's beneficial for it to do both. You need the store of value as one option. You need a payment platform as another option. So I think the thing is for me, once it finds its kind of true form, I mean, I go back, I think it was around 2017, 2018. I had a prepaid Bitcoin card, and it was, one of the first on the market. It was, it was like the week that it launched, I was in there. And I remember transferring $100 as a test. And I went kind of exchanged it from a hardware wallet, and this was hard at the time. This wasn't an easy kind of, application quick fix. It was, you had fees, you had transfer rates, you had all these different things, as well as the fluctuation in price. So what happened was I transferred this $100 as a pure test. It was like, I'm going to go and see, what this looks like and how it works from start to finish. Put this $100 in from a hardware wallet, got charged fees. Put it into this kind of application, got charged fees. Went to the bank, the price had dropped, lost money. All of a sudden, my $100 in Bitcoin is now worth, 51. And I'm thinking, this isn't the ideal scenario when you're trying to adopt this in countries like, El Salvador recently, or third world countries. And this could be a charitable type play, for example. If you've got this much volatility and you've got this much uncertainty, it's very difficult to kind of really get behind the technology for what it should really be capable of doing. Why would I want to kind of, make an investment from a VC fund using Bitcoin if I could lose half my Bitcoin, from making the transaction without that technology company, making any money? It almost needs to find its feet for me, for it to be truly accepted, and I think these fees, these brokers, these middlemen, a lot of that needs to be kind of shaken out, whether that's, regulation or other factors. I think a lot of that needs to be shaken out for it to really thrive. And I think, when it does do that, I think it will. I think when it does do that, you're going to lose a lot of the, the influencers, because the 100x returns are no longer there. You're going to have more institutional money, which means it's less volatile, it's more stable. And I think the stability will point it down. It's a payment platform or it's a store of value. And I think at that particular stage, it'll start to drive higher prices per Bitcoin.
I've had that thought actually with the institutional aspect of it. Is I would think as more money and interest comes in, the price would tighten a little. And I wonder if maybe do you see that long term? So kind of even taking out some of the kind of we didn't talk about fractals earlier, but I heard you mention it when discussing Wyckoff, because I can see how you could use that on different time frames. Is that something that you could possibly see happening? Say you just were to do like a long-term Wyckoff analysis of Bitcoin. Do you kind of maybe see the trading ranges tightening? Because I do wonder, more traders just means that the competition grows greater. Thus, like the spreads get tighter. It just seems like it'd be harder to move. But curious to hear your thoughts on that.
Well, I think, obviously, like I said, it brings opportunity. But I think the problem being is it's what it does on one side. It's almost like a scale. It kind of counterbalances, or it's kind of a counteracted on the other side. So I think when you manage money and from a VC perspective, private equity, hedge funds, any kind of money management per se, you're almost, your primary focus is not to make money. Your primary focus, which sounds insane, is to safeguard money. You need to manage those assets, not to lose them, not trying to make 1,000x returns. If you were a retail trader, and you've only got $1,000 to play with, it's almost your sole mission to go and make 1,000x returns, which is, I think, why a lot of these influencers, have the following that they do. I think the irony is, when you understand how these algorithms, how the market works, how it fluctuates, you understand, more money is almost being deployed with less risk. And it's the less risk that, for me, makes it easier to read, because the markets are doing what you expect them to do based on, bigger players, institutional players, treating it the way that they treat other assets and other instruments.
So that's another tactic that I really like, and it ties back to the fundamental with technicals once again, which is putting yourself in different positions, or sorry, wearing the shoes of a big money manager, or wearing the shoes of a small retail trader, and seeing what all these different people want out of markets. And especially the aspect of protecting capital. I think once again, there's that great quote about it's not so much about the return on your capital, but the return of your capital. And but being able to put yourself in the shoes of those different types of people, I do see having a great edge, because then you're more well aware of who you're trading against, which is sort of a reoccurring theme in markets, is you're always trading against someone or something.
Yeah, and I think this is the main thing, right? So when I showed earlier COT data and obviously the leverage funds, what the big boys are kind of thinking, and although it's lagging data, it's enough of a sample size to give you a good, bias. When I look at Elliott Wave, it's kind of pointing which direction I want to point in. I don't really care about every single swing, every single move. I just want to, am I going long, am I going short? And then I can start to drill down, in terms of then the more detailed approach into the entries. But I think the thing is, when you start to understand, how that works, why that works, the fact that these bigger players come in and, like I said, institutionalize the market, it gives the comfort and the confidence that the market is doing what it should be doing. And then I think from a retail perspective, because they are trying to get rich quick, they become the liquidity, for the professionals. So I think it's a really tricky one. But when you understand all of this, it's so much easier to say, well, my bias is long, based on the retail sentiment being, short, and I think, as you say, when you get these kind of, tightening of price, it's tightening for a reason, and I think this is the main point, this is the main, advantage of trading like this.
You just said something that really sobered me up, which was about retail traders being the liquidity for professionals. I'm a retail trader after all, so I find that pretty sobering. That's right. I'm just the liquidity for the professionals. Nonetheless, though, and I was thinking about your book while you were talking about that as well. In your book, is this sort of what you're diving into, all aspects of markets? Are we covering a lot of the topics that you cover in your book?
So to give you a bit of background, a bit of context on that I've obviously been doing this a long time, and I'm one for making notes and kind of covering lots of different things. So my son, when he was 11, he basically took an eToro training course and was like, I like this. I want to do the same as dad's doing, that type of thing. So I ended up saying, look, I'm going to write him almost an instruction manual, just as something to do. And when I started, talking about it, and a couple of people said, you should write a book. And I thought, well, actually, yes, I think I will. And I think what I tried to do throughout it was to create this kind of chronology of what I've experienced in my time. So when people start with, indicators and it's not just a broker thing, but I think, if you look at what you get when you sign up to a broker or exchange, it's normally a moving average, an RSI, all of the kind of retail simplistic tools. And therefore, well, if 90% are losing, let's try to kind of take some of the factors out of that 90% of the loss. And therefore, you can kind of step into, okay, now what am I looking for? Well, I'm trading, too short of a time frame. Everybody gets excited when Bitcoin moves $100 up or down because they're only seeing, on a 1 minute chart, that massive move. I think when you step back to what we covered about, having less screens, having less indicators, having less to learn and understand, you kind of understand and you appreciate that it's a sequence. And the sequence that I've tried to then deploy in the book was almost like I'm writing it for an 11-year-old kid to understand how you start and how you mature into understanding these markets. So that was kind of the premise of the book and the kind of the backdrop and the kind of rationale for me behind this, because as I mentioned, it's an art, and it's an art form, I feel, that you need to appreciate that, retail are, liquidity pawns, and, professional money makers are coming after you. And I think this is another cool topic that I know I've touched on a few times. And Paul Varco, obviously my business partner that you've met and spoken with. I think the thing is, if you're a doctor or a lawyer, an accountant, and lots of other professions, you spend years and years in university. If you become a trader, you don't watch 2 YouTube videos and become professional overnight. I think the reality is you still have a lot more learning to do. And I think when you realize that you are playing against the professionals, the problem that you have is you've watched 2 YouTube videos, you think you can beat the world with an RSI strategy on a 1 minute time frame. It's like, well, thank you very much for your liquidity. And I think as soon as people start to realize, whoa, let's take a step back and less is more, they start to realize that, it's so much easier than it needs to be.
The aspect of doctors or lawyers spending 4 to 8 to 10 years doing schooling, graduate work, rotations, right? They're in and out of even internships just to get to where they are. And then the number of traders who who maybe go to a YouTube channel, exactly, watch a video and then say, "Yeah, I'm the next Warren Buffett." It is there is some, there's some amusement actually to that, and hopefully people watching or listening get that reminder as well, that it takes a lot of time. And actually, the manual for your son, sort of writing this manual for him as he gets started, I really like that phrase. And I was actually thinking about myself too, just over my career of trading or even investing. And it's interesting to see how much I've learned along the way. And I wonder, as you wrote the book, if that was a nice reflection process for you. So you've been trading for 20 plus years, and you're writing this book going, wow, that's how I traded 15 years ago, and now look at me now. Did you have some moments like that, and you were able to sort of reflect on your own growth?
Yeah, 100%. And I think this is what I mean. I've been very lucky, kind of in other aspects of life. And I think, I moved to France 9 years ago from the UK, and kind of just taking a bit more of a chillaxed lifestyle. It started off as a 6-month thing, and I've been here 9 years. So I think for me, what I've really got to appreciate, especially with the French lifestyle, is that there's more to life, and I think if you spend the time watching the charts, you're in and out of the markets too often, you're trying to assess too many pairs, all of these kind of, what you see as great things, there's no secret sauce, there's no silver bullet. This is a lot of hard work, a lot of dedication. And I think ultimately it's, if you want to be the best lawyer, you want to be the best doctor, it comes down to experience. I think what I've tried to do in terms of, writing the book, and obviously that's, this one here, what I've tried to do there is, obviously, like I keep saying, it's an art form. You really need to master the art. And I think for me, it's been a journey that you would have had as a doctor or a lawyer, over a 30-40 year career. I'm halfway through my career is the way that I see it. I'm 38 now and been in the market 23 years nearly, so in the grand scheme of things, it's still a learning curve even for me. And I think you need to treat it like that. And this is where we come back to, don't listen to other people's opinions, do your own due diligence, don't overthink it, don't overcomplicate it, don't go taking too much sentiment from other people. And all of these things will help, anybody kind of move forward. It's, you're not going to have, I'm a doctor and I'm doing some surgery, and another doctor comes in and says, oh, don't do it like that, do it this way. I've seen this on YouTube. That's not how it works. And trading shouldn't be either.
I want to touch up on one or two more things, and
Yeah.
you mentioned the French lifestyle, kind of opening up your mindset to a new way of living. And as you know, we're recording this show from Manhattan, so you can imagine the cars, the ambulances, the sirens, the people, the restaurants, just all the activity.
Yeah.
I have to hear more about how the French lifestyle changed up your approach to markets. Did it? So you're more disconnected than usual, or I just please tell us more about that, because especially as we talk to a lot of traders now who are global, it's pretty
Yeah.
cool to hear these stories.
Yeah. So in essence, like I said, I was working in London, living in Wales. So it was a kind of 2 hour kind of commute. And it was, I would go maybe once a week, twice a week. I go into London, kind of hustle and bustle. You jump in a taxi, you're stuck in traffic. You kind of jump out and jump in the train. It's full of people, and I just thought, like, I can't live like this. This isn't living. This is surviving. This is just kind of moving on. And I called my wife one day and said, look, let's move. And she said, where? I said, well, anywhere. I said, just go find somewhere to move. 3 weeks later, we were living in France, and we kind of rented this property. It was, let's just see if we can do it. Let's see if, the work was okay, if I could, kind of cope with the language. And, within 2 or 3 weeks, it was like, yeah, this is a change of pace. It was like going back 50 years in time. It was just a much more relaxed lifestyle. And we ended up then buying a property out in the countryside. It's a 200-year-old building. We've got outbuildings that are 400 years old. It's space, we land. We've got 4 neighbors within 200 hectares of us. So it kind of changed how I saw everything from, not having traffic on the road in the morning. I can drive to the local shops and not see a car. I can spend the time in the garden and not have any neighbors. And I think all of these things help along the way when it comes to trading, and how clear your mind is. A lot of famous CEOs, a lot of kind of money players, they all talk about meditation. I think what I try to do is kind of make life, a meditation, and ultimately take the step back to say, my phone's always on silent. I check my emails when I can be bothered. Most of my days now are spent on TradingView, playing with charts. And I think for me, it's just something to keep your mind active rather than needing to, wanting to, because it can eat you alive. I think, you have a couple of bad trades in a row, it gets to you. You have then, Twitter, somebody kind of showing their jet or showing their perception of a jet or a super yacht. And I think ultimately, you think, well, I want to be in that boat. I want to be in that, in that ballpark. And I can't with the kind of money that I'm sitting on, or I can't because I don't understand enough. And you get suckered into the same trap. These guys have sold you the dream. You get suckered into that. I think coming to France allowed me to completely step away from, no shoes, no news type of mentality. It was, we're in a farmhouse in the middle of nowhere. The sun is almost, always shining. The food is that much better. The lifestyle is that much better. And you just feel so much more relaxed kind of for it.
I think you just single-handedly increased the property values in the countryside of France because there's going to be a lot of traders and investors saying that's the secret. That's the secret sauce. That's fantastic. And Mayfair Trading, I really appreciate your time on the show. I noticed that we hit an hour and we're almost approaching an hour and 15 minutes. So really good discussion. And, we could keep going. This is still the early days, though, for the TradingView show and TradingView podcast. So what we'll have to do is have you back on at some point. Yeah. And I really think that ending on the note of France is a perfect way to end this show. And I think a lot of people will actually enjoy those words as well. Is there anything else that you want to leave the listeners with, or maybe one final message?
No, I think, like I said, apart from plugging the book, go buy it. Other than that, I'm all good.
Lewis, thank you so much for for joining the show. And once again, to anyone listening or watching, you can follow Mayfair Ventures on TradingView, Mayfair_Ventures. You'll see his profile just by doing a quick search on the TradingView search bar. And you'll get some updates from him at least, I feel like, once a week. Very active, and you probably learned something new along the way. So thanks so much for watching. This is episode 8, and we have many more on the way. We'll talk soon, Mayfair Ventures.
Cheers.
See ya.
Thanks, Stefan. Bye.